Now we're going to talk markets and economies with another great genius of this show, Shane Oliver, AMP Capital. Not investors anymore, AMP Capital. Why did you drop it for? Yeah,
I'm not into...
Yeah, ask those questions. You just operate under the name they want.
It happened when we merged with AXA.
Yeah.
And the decision was taken that it was too complex to have investors on the unit.
Yeah, I always thought it was excessive. AMP Capital, that sounds solid to me.
But you could get the acronym ACI.
Yeah, I haven't done that. Yeah.
Well, that's what we used to call it internally, but now you can't do that anymore.
No one ever called it ACI outside of it. It's AMP because that's easy. All right, so you're here. There's been some interesting stuff happening this week. Let's start in China. Down yesterday. Inflation. Central bank could raise interest rates. Today, great manufacturing numbers. Market up. What's going on?
Well, Chinese investors are obviously very twitchy, and the problem with that market is that you've still only got a very small proportion of foreign institutions, so it's particularly dominated by Chinese retail investors, and they're very twitchy. So I think there's also a bit of nervousness around when the central bank last week failed to inject liquidity into the system. Did the same thing this week. I think yesterday there was a fear that we're going to have another rerun of the little mini credit crunch we had back in June, July. And obviously the overnight money market rates jumped up. There was a fear that the central bank, well, there is still a fear, the central bank is getting worried about the rise in inflation, the surge in property prices we're seeing in China, and therefore they're going to tighten policy. My take on it is that that's probably pushing things a bit too far. I think you have seen very strong capital inflows into China, and the central bank is just trying to mop some of that, or not mop some of that up, or not add to it. And the other thing is when you look at inflation, strip out food, the underlying inflation rate's 1.6%. You look at house prices, yes, they're up 9% over the last year, but income growth in China, this is not Australia, income growth in China is running around 10% per annum. So you're still seeing over the last few years, last year house prices were up 2%, the year before flat, incomes over that period up about 10% per annum. So you're still looking at an environment which is not bubbly by Australian standards. House price to income ratios are not surging like they have it in Australia over the last decade or so.
Is okay then?
It's not too bad, and many Chinese show up with something like 30% deposits. Many of them, when they buy a house, they buy it outright in cash. You don't have the sort of...
Cash works in China?
Well, it still does. Cash works still in China. I'm sure they're using bank transfers to do it, though, so you may actually see the cash.
Big discounts for cash in China. Yep. So your feeling is then China's still heading in the right direction to help the Aussie economy with our reasonably rosy scenario we've got for 2014.
That's right.
Good man.
But the trouble is, people like you in the media here want to dramatise things. A little while ago, maybe not you. You're a bit more balanced.
Yeah, but if we make it boring, people won't watch.
No, I know. I understand
but
that.
We always aim to get it right, and we have been right. But go on.
Yeah, you have been right. You have done a few good calls here. But if you look at China, there's always a crowd out there saying that it's going to crash. Every 6, 12 months, these people...
Chanos in New York, he's always doing it.
Chanos, I mean, it's classic. Wheeling out the stories about ghost cities, about excessive lending, all this sort of stuff.
Since 2009, he's just been hammering poor old China. One day he's going to get it right.
Yeah, one day. But
Dr. Mark Faber's another one who's always...
I just don't know when it's going to happen, though. And the trouble is, when I look at China, I see reasonable economic management. The debt levels, yes, they've gone up, but they're not at onerous levels. China, when you map it against other countries around the world, debt levels are still at the low end of the range.
When you're a cautious guy, Shane, aren't you? If you were worried about China, you'd come on and say, I'm worried about China, wouldn't you?
Yeah, but I'm not worried about China. Now, the flip side is I don't see a boom. I don't see a return to the 10% plus growth. I think you've got to take the Chinese authorities at their word these days when they say we want growth around 7.5%. That's probably what they want.
But they don't need 10% because the economy is actually bigger, isn't it, Shane? For us to get the kind of demand, reasonable demand for iron and coal, if they grow around 7%, it's kind of the same demand they had when they were growing at 10% on a smaller economy?
That's precisely right. 5% growth today, and we're well above that, would probably be equivalent to about 10% 10 years ago. So the amount of demand, physical demand, that BHP and Rio are seeing is actually far greater than it was a decade ago, which is why, through the course of this week, BHP told us their production's gone up. A whole bunch of factors there, but the bottom line is there's someone out there who wants it, and that's China.
Yeah, good old China. Okay, that's the China story. Let's go to Australia now. Inflation 1.2% in a quarter. Should we be worried?
Well, shock horror.
I thought were in the news. You just said shock horror, but you said shock horror.
No, I'm too subdued to do that sort of stuff. But
you're an economist.
When I saw it, I thought, yeah, a bit of shock horror for a few moments there. But then when I printed the publication out, which sometimes you've got to do with these things to look at it, I saw that petrol prices up quite significantly. I saw airline overseas travel prices up 6-odd%. So obviously the fall in the Aussie dollar that occurred 3-4 months ago
when we got
had
snuck into the 80s.
Had an almost instantaneous effect on those items. And then, of course, you've got good old electricity and utilities. They were up another 6-odd%. Local governments raising their rates 7-odd%. They're the sort of things that pushed it up. Now, if you think about the underlying rate of inflation, because
that's what I was going to say, that's the more important one.
Those things that I just mentioned, not the ones that the Reserve Bank's going to get fussed about, you have to look at the underlying measures. They were 0.6% on one of them and 0.7% on the other for an annual rate of 2.3%, for the year to September. That's well in the target range. Not as benign as some of us might have hoped, but still pretty benign. There's nothing in there saying the Reserve has to jack rates up. My feeling is the Aussie dollar's stabilised since then, in fact gone up a little bit, so inflation's probably going to fall in the current quarter. And I still think there's a lack of pricing power out there amongst Australian companies. So I don't see inflation as a threat. Maybe in a year or two's time when the economy picks up, as we expect it will, but right now I don't see it as a problem.
Look, I'm canvassing this point of view with you because I'm actually thinking of running in my Australian article on the weekend that somehow seeing a little bit of inflation coming back is probably not all that bad, because that's more like normal times. Like in normal times, people borrowed, inflation was a bit of a threat. You're more likely to see interest rates rise and fall. That's what you get during normal times. We're in abnormal times at the moment, aren't we?
Well, that's right. And particularly in America, they've got inflation even below that. So a person like Janet Yellen, who would take over from Bernanke as Fed chairman January next year, I mean, she would probably want to see a bit of inflationary pressures rising, and the Reserve Bank would probably want to see the same, inflation sort of stabilising around the 2.5% zone, and that would tell them, it's just another sign, things are heading back to normality, as you said, and that at some point out there they can start getting interest rates back to more normal levels. Trouble is, that's probably still a year or so before they start doing that.
I think you also hit on a really important point that people forget. It's actually nice when businesses can get a bit of pricing power, because then they're more confident to hire workers and they're more confident to invest, and that's the whole growth story happening.
That's precisely right. I mean, people who are hankering for deflation or zero price. I mean, zero prices, if you actually measure it, the quality adjustment would mean that you just probably, in reality, you've got deflation. But just go and look at Japan over the last decade. No one invests, last 20 years in fact, no one invests when prices are falling the way they were, because companies have no confidence. No one buys property because you think, oh, well, I can buy it for 10% cheaper tomorrow. You delay buying goods in the supermarket or household items because you think they'll be cheaper at some point down the track. So no one wants falling prices and deflation.
Okay, take your economist hat off now and put your investor hat on now. During the week, I saw Anton Taliaferro. The G is silent, I'm sure it's silent, from Investors Mutual. Bright guy, always been good on the markets. He's sort of expecting a correction. Are you expecting a correction?
Well, there's always corrections.
And we have up 25% since last November.
Yeah, we have, but there's been a few bumps along the way. If you go back, I mean, like early part of last November, there was a bit of a bump just after the US election. Not much of one, bigger one in America, actually. There was another one in May, June this year when the Fed started talking about tapering. China was jumping, central bank there was going through a midi credit tightening. So we have had a few bumps along the way. We had about a 3 or 4% correction, a few weeks ago as we're going into this fiscal uncertainty in America.
And I think we're only up about 15% since July or something. So there was a bit of a hiccup in March, April and May, wasn't
there was a bit of a fall going through May, June. And then that sort of set us up for a stronger July and August. So, I mean, we could have a bit of a pullback. It wouldn't surprise me, but I think the broader picture...
Pullback's a nicer word than correction.
Well, it'd be nice and healthy.
Less than 10%?
I wouldn't go that far.
Officially. I'm not showing Oliver definition. I want the real definition.
Correction's
a 10 and a crash is 20, isn't it?
Well, I think a bear market is when you've got a 20% fall and it's not corrected within the space of 12 months. If you
Right.
come down 20%, we have done this a few times, like late 98, we came down more than 20%, and then you suddenly bounce back again. That's not a bear market. It's still in the realm of a correction. But I sort of think of a correction as anything much greater than 5%. A bit below that is consolidation. So
there's actually a crazy term which I found during the year, which I shared with you.
You may have referred
I've
to it.
forgotten it. I've forgotten what it was. But I'll go back to that crazy term next time if it happens. Anyway, okay. So
there could be.
You're not worried, but there'd be a buying opportunity.
I would say there's a buying opportunity. I was thinking that there was going to be a correction over the last month or so because we had a few worries there. We had the Syrian issue. We had whether the Fed was going to taper or not. We had the uncertainty about who was going to take over at the Fed. We had the fiscal issues in the US. We had the German election. We had Italy. All this long list of worries, and nothing much happened in the end. All of them are history now. But I guess you've got to bear in mind markets are a bit overbought. So you could go through a week or two where markets come off 1-2%, a week, and then pick up again. So, if you spend too much time worrying about that, you miss the big picture here. And the big picture here is that the global economy is gradually recovering, not too fast, such that we get worried about inflation and interest rates, but nevertheless picking up gradually. Europe growing, the US growing, China stable growth around 7.5, bit more on the more recent numbers. Japan, believe it or not, growing. And I think there's confidence, there's enough evidence to suggest to me that the Aussie economy will start to pick up pace through next year.
214 better than 213.
Yeah. So all of those things, I think, provide a good backdrop for shares and give me confidence that, shares are not as cheap as they were a year or two ago, but we're going to get the profit growth coming through. We've still got a very easy monetary backdrop. All of that suggests to me the broad trend in shares is still up. And you've got people saying, well, I'm getting 3.5%, my mother, I'm getting 3.5% down the bank. Hopeless. Or if you go to America, it's 0 down the bank. I'm better off in shares. And so I think that if you do get a correction, it's going to be the same old, as we've seen over the last little while. Buy on the dips will kick in, and it may end up being less than you're perhaps hoping for.
I read Richard Coppelson from Goldman Sachs yesterday. I don't know if you saw it, but he said it's very rare that the Dow goes up 9 days out of 10.
I've seen that.
He said, but this year we've had it 5 times, and that's why he's arguing that we're in a multi-year bull market. And he's very confident for 2014. So I guess you're a unity ticket with me, or him, you and me.
Precisely.
Yeah, good man.
We'll go together.
We'll go up together, go down together.
As I said last time on the program, 2 weeks back, I think we're in a secular bull market globally, particularly in the US, and that's going to flow through to Australia. So America's had 13-year horrible period. It's now breaking out of that. That's I think that's a positive backdrop for Australian shares.
You'll tell us first.
I will.
Okay, mate. Now, all governments deserve at least, I think, a year before smart aleck commentators start turning on them for big order issue mistakes. And really, the former government, now opposition, should think twice before they start throwing economic criticisms or crap at the new team running the show. This is what I was thinking when some people in the media were trying to draw analogies between the US debt ceiling drama and Joe Hockey's decision to raise our debt limit to $500 billion, or as the new opposition finance minister Tony Burke likes to call it, $500 billion. Now, I have to say, it reminded me of Mike Myers' Dr. Evil when he said that. But the irony is that Joe only has to increase the debt ceiling because the former government, Burke's mob, did not do enough to get the economy growing fast enough to bring the deficit down into surplus. Surpluses will reduce the debt, and growth is the key as it brings in taxes and creates jobs. Now, I reckon Joe has shot for $500 billion, a limit of that size, just as a business would with an overdraft. And so his test of success will be based on whether the debt is kept under that figure. So when Tony Burke says this,
the way we'd like to get permission for debt to go to $500 billion.
all I can say is, give me a break.